Hello, everyone, and welcome to the Your Mark on the World show. I'm your host, Devin Thorpe, and this episode is produced for Forbes, where I'm a contributor covering social entrepreneurship and impact investing. Today, our guest is Matthew Weatherley-White, the managing director of the CAPROCK Group. And Matthew, welcome to the show. We're so happy to have you.
Yeah, thanks very much, Devin. It's great to be on the show with you.
I was thrilled that our friend Abigail Noble introduced us so that we could have this discussion today, but you are one of the key players in impact investing, and I think I come at that conclusion because increasingly what I'm seeing is that it is families and high net worth individuals who are really, I think, leading the way in impact investing. It's not so much the institutions, it's not the foundations and the banks that are leading the way. They're really following, and it's great to see them following, but they're following you and the community of people you're helping to lead. I want you to just talk a little bit about why you think it is that families, family offices, and high net worth individuals are kind of leading the way in impact investing.
Well, Devin, I think there's a confluence of forces at work here, and I'm not going to share any blinding insight in this observation, but the after effects of the financial crisis in 2008, the growing recognition of the reality of resource constraints, the transfer of wealth to a younger generation, in particular the millennials, and I don't like to just pigeonhole millennials like that, but I think it's a reality in this case. And I think the most recent IPCC report on climate change is that those are all admittedly anecdotal, but those are all demonstrative of the kinds of forces that are coming together to support and further this notion that the steering power of capital can have a positive influence on the role of capital in society and the way that we think about optimizing within the capital markets.
Do you think that the reason that families and high net worth individuals are moving in this space quicker is that there is less bureaucracy, or are there other reasons for this? I sometimes look at old institutions, even foundations that are relatively small, as just having a lot of inertia that an individual or a family wouldn't have. Am I reading that right, or do you think there's another reason?
You absolutely are, and I think that it's a combination of a pioneering spirit as well as the ability to make decisions quickly and to move swiftly that has resulted in families really driving much of the activities going on in impact investing right now. And I can say that through personal experience, I'm incredibly grateful to work with the families that have entrusted us with their capital and have thought of us as thought partners in this exploration of impact investing with them. But as I said, through personal experience, it is amazing how pioneering these people are, and I don't mean that in a sort of an unctuous way. Oh, how great is it? But like literally, they are looking at a completely unconventional set of risks around impact investing, and they are figuring out ways to incorporate those risks in the way that they see the world, and the way that they see their role in the world relative to stewards of sometimes significant pools of capital. And they're willing to put that capital at risk in order to validate this thesis around impact investing. And it is unbelievably cool to see that. And I think your point earlier about the institutions sort of being followers in that regard, I think that's very much what's happening. And I don't actually use that as a criticism. I simply recognize that that is a fact of large institutions. They can't move as quickly. They can't take those same kinds of risks. And there may even be institutional obstacles to that kind of innovation absorption. But as a result, since I work at a multifamily office and we serve families, we get to be on that cutting edge with them, which is unbelievably exciting from a professional perspective.
Well, it is, and I'm a little jealous. So I'm going to have to live a little bit vicariously through you today. But tell us a little bit about some of the approaches that the families have used, or that you've used with the families to actually do some impact investing.
Yeah, so the CAPROCK Group, we are investors first. So the families that have hired us typically are emphasizing the investment merits of their impact investment strategy rather than, for example, the philanthropic merits or maybe even sort of concessionary return type investments in the social and environmental space. So that's a really important lens to bring to this whole conversation. So even though we are talking a lot about impact investing, at the CAPROCK Group, we really focus on the investing piece first. And that's not to say that we discourage innovative risk-taking around impact with the clients, but rather that we just make sure that when we deploy our capital, there's a reasonable expectation that we're going to get it back, hopefully with a profit in the form of yield or appreciation. So in terms of the processes that families have used to pursue this, I think that the first hurdle is to overcome that sort of emotional fear that investing with an environmental or social lens will, by default, result in performance, lower performance. Because I think that fear has been drummed into most investors by a lot of the institutions that currently serve them. And I think that that's one of the things that families have to sort of get over. And that's not to say that there isn't the potential for poor performance, is that it's not a default assumption. We have seen really extraordinary investments that have clear social and environmental missions baked into their business model. So we know that there's not a default performance sacrifice when doing this. So that's sort of the first process. And then I think it's really a question of identifying the family's mission. It's easy with a pool of philanthropic capital because typically the mission is embedded in the formation of the entity. But families aren't usually that clear, so they need to go through that process of identifying their what we call theory of change, i.e., what do they think needs to happen in the world to affect the challenge that they're trying to address. And there are several people who are really, really good at helping families think through that. We've had the great pleasure of working with Jed at Emerson, for example, together, and those guys really know how to help families think through that mission identification, values alignment, etc. And then when we step in, we're really helping them to deploy capital in alignment with that core set of values in a way that solves for their financial requirements. Did that answer your question? I feel like
I think that's exactly what I was looking for in terms of process. Now, I wonder if we can drill down a little bit. I don't want you to reveal any trade secrets, but if you can give us some specific examples of impact investments you've made, I think it will really help people to understand what it is we're talking about. Because I think for a lot of people who are listening, this is more abstract than practical still. And so if we could get an example or two, we can really make this a little more rock solid.
Sure. So I'll have to be a little bit careful. Obviously, we're a SEC-regulated entity, and I can't be seen as making investment recommendations or endorsing a specific investment. So I just want to sort of put that disclaimer right out front. But it's a good idea to talk about some specifics because we need to reduce this abstract notion to a more concrete, action-oriented conversation. So I'll just pull one sort of out of my hat. So there's an interesting firm named Microvest. They do microlending to microfinance institutions, primarily in emerging and frontier markets. They have been around for quite some time. They operated early on effectively as a nonprofit, funded by a nonprofit, and they've grown significantly recently as they have been placed on the platforms of some of the large broker-dealers. So, Microvest is, in our way of looking at it, a specialty lender. They are willing to lend capital into areas that are misunderstood, probably are mispriced from a risk perspective, where there might be really unconventional underwriting standards to really get a sense of whether or not they expect to get their capital back. So they do some really interesting underwriting, right? And in that way, they're not dramatically dissimilar from some of the specialty lenders that we might see in the developed world. They're just targeting a very different sector of the a sort of economic ecosystem in frontier and emerging markets. So they go in and lend capital. Along with that underwriting, there's some very clear social metrics that they're measuring. What percentage of their borrowers are women? What percentage of their borrowers are starting new businesses? What percentage of the borrowers have community support? So they think about the way that capital can support and build resilient communities in countries or in areas that might not have that sort of resiliency cushion in them. So then, interestingly for us, when we did our due diligence on Microvest, and remember, Microvest positions themselves very clearly as an impact investing fund. When we started looking, we said, wait a second, these guys are just specialty lenders. They happen to have this really interesting social component to the way they think about deploying capital, but they're really specialty lenders. And so we looked at their default rate. Well, their default rate is astonishing. Now, I might be misquoting this a little bit because I don't have the details. I'm not looking at them, but I don't think they've had a single default. Or if they've had 100% recovery. So their track record in this sort of arcane, poorly understood world of specialty lending into microfinance institutions and frontier and emerging markets, they do it really, really well, right? So I think in a conventional world, one might look at this specialty lending discipline and say, oh, why don't you just lever that up 4x, kick off 12% net to your investors, and all of a sudden you're a rock star investor. Well, that's not the way they think, right? So they would never do that. But I think that's a way to start to think about how an investment with an impact lens might actually be very closely related to a conventional investment, but would have these really cool social elements to it, which are additional.
Yeah.
One
really
example.
Great example for us to think about this in a more tangible way. Are your families that are looking at
class and 20 different ideas, but that's one.
Their asset classes?
Okay, I'm sorry, I was talking while you were talking. My apologies. Can you ask that question again?
Sure. How do your families allocate assets across asset classes in terms of how much is going into impact and how much is going into other areas?
Yeah, so there's a couple of ways to answer that question. The clients that we work with tend to be pretty committed impact investors. And by that, I mean that their intention is to eventually deploy 100% of their capital with an impact mandate. That is their intention, and it's clearly stated. But there are issues of absorptive capacity. Not all asset classes are sufficiently mature to absorb a great deal of impact capital. Some sub-asset classes, so some specific strategies, don't even have impact opportunities. So there's a time constraint around deploying capital with 100% objective. And then there are other clients other families who are not clients of ours, who are very curious about impact investing. And perhaps they're going to identify a percentage of their portfolio to test whether or not they do want to pursue impact investing with a broader part of their portfolio. So I think that the clients that come to us exist on that continuum. Some are way down the road and really, really passionate about it. Some are just curious. But I think that one of the most interesting things that we've seen is that there is now starting to be a cross-pollination between our conventional investors, non-impact investors, and our impact investors. And we've already seen that there is a great deal of influence from our conventional investment methodology on the way we look at impact investments. We're investors first, right? But we're starting to see is that our diligence on conventional investing is starting to be informed by our diligence on impact investing. And obviously risk mitigation on climate change is one that would appear in both. But even things like the percentage of C-level offices and board representation that reflects women. That's something that is now part of our conventional diligence as well as part of our impact diligence. So there's this really interesting sort of blurring of the lines. And I think that if I had a magic wand and could create a future 10 years from now, I would say that the term impact investing doesn't exist anymore. And it's just simply investing. And what we think of as incorporating social or environmental metrics is just simply part of responsible, good, reasonable investing.
Yeah, I think that's a great vision for the future, and I think I think that makes perfect sense. I wonder if you would just take a minute here before we wrap up and explain to people who you might be interested in talking to, how you might help, how they can get in touch. I'm sure there will be people who want to reach out to you. I hope some of them are wealthy families, but give us an idea of who and how who should contact you, for what, and how they should reach you.
I didn't realize this was going to be an opportunity to do that. I think anybody can be an impact investor. I think the challenge right now is that there are not many impact investments that are really accessible to somebody who is not an accredited or a qualified investor. And so the threshold in terms of assets, et cetera, is kind of high. But there's a number of firms that are really working hard to do what we call democratizing access to impact investments, and TriLink Global comes up immediately to me. They're just this super cool company that is doing SME, small to medium enterprise trade finance in emerging markets, and bundling that in a package that's available for retail-sized investments. So that's one. But if you wanted to get in touch with us, best thing to do is send an email to I3, that's the acronym for Integrated Impact Investing, but I3 at thecaprockgroup.com. And we have a dedicated impact investing team here. We've got folks up in Seattle, we've got a team down in the Bay Area, and obviously our core office is here in Boise. And that I3 at thecaprockgroup.com will get to the whole team, and so we will know not to drop the ball. In terms of sort of who we like to work with, we really prefer to work with families, as we talked about at the top of the call. We think they're doing really interesting, dynamic stuff right now. In particular, if there's the ability to work with a family that has a philanthropic pool of capital as well as a commercial pool of capital, we think the intersection of nonprofit capital and for-profit capital is really, really fascinating right now and really inspires us professionally. And then, worst case just scenario, just Google us and call us, the CAPROCK Group.
Fantastic. Well, listen, Matthew, thank you very much for taking the time to be with us. We love what you're doing and hope you'll be fabulously successful in growing that platform and in continuing to drive impact investing home for the rest of us.
Thanks, Devin. I hope it is hugely successful for all of us, particularly relative to climate change.
All righty. Let's do some good.